Thank you, Alexander, and good morning, ladies and gentlemen. I do have a crystal ball, and so what is the outlook for 2019? I guess the first question to ask is whether what we're seeing around us from financial markets is signalling recession ahead. We've seen very sharp falls in equity markets. We've seen the US bond market yield curve invert, which has previously been a signal of recession. Business confidence has slipped. Are we about to see recession? We don't think so. And I think with the perspective of looking back a few years, you can see from the red line here that although we've seen a sharp fall in global equity market prices in recent months, in fact they're down 8% on the beginning of the year, they're still at a level which is 20 or 30% higher than they were in early 2016. That's still consistent with business expansion and profits. And I think the reason that the Treasury bond yield curve is inverted, i.e. short-term interest rates are at or above bond yields, is because of the extraordinary monetary policy we've seen in recent years. The US Federal Reserve has bought something like $3.5 trillion worth of US Treasuries, which is keeping bond yields down. So, we don't think that what we're seeing in financial markets, worrying though it is, signals recession ahead. But I do think there's a lot to worry about. And trade and protectionism, I think, is a major concern for the industry. We as an industry depend on open borders. We depend on borders with very little friction. And we're seeing a lot of worrying developments. The latest of which, of course, are the tariff wars between the US and Japan and perhaps other countries as well. Is this, if we see an escalation, going to stop the global expansion? Well, we've illustrated here the conclusions of a study by Citibank looking at if the US president decides to raise tariffs on Chinese goods to 25% at the beginning of the year. No, that would shave, that is damaging. It will shave something like 0.3% of growth. And they conclude that if there was a further escalation to tariffs on all trade between the two countries, it would shave 0.5% of growth. So damaging is something that we would like to avoid, but we don't think it will stop an expansion in 2019. I guess the other big uncertainty, and it's even more uncertain at the moment, is Brexit, which has led to a whole number of estimates of the impact of Brexit. I wanted to concentrate here on the longer term effects of Brexit, if it takes place, because of course we don't know at the moment whether or not it will happen. Hopefully we'll get some clarity soon. I should stress there are really two parts to think about in terms of the impact of a potential Brexit. The first is the immediate confidence effects. And to be quite frank, we don't really know with any certainty what these will be. And I think that is the problem that analysts got into when Brexit was announced or proposed in 2016. So we haven't shown those here. But what we are more certain about is that Brexit, if it happens in whatever form it takes, will impose trade costs, will impose costs at the border. And this is what's shown here. So they are serious. This shows some numbers from the National Institute in the UK. If there's no deal, it suggests that the size of the UK economy will be 5 or 6% smaller than it would otherwise be, which of course is a significant cost to the UK economy. But I guess the point I wanted to make is we're still expecting to see expansion. This will slow, but not stop growth in the UK economy in the long term. And consequently, what we see from mainstream forecasters for the outlook for the economy next year is actually continued growth. From people like the IMF or Goldman Sachs or Citi Investment Bank, they make the point that business investment is still growing, the US economy is still generating jobs at a healthy rate, we still have expansionary fiscal policy, and indeed we're seeing that in France now. So we would expect to see slower growth next year, but still expanding at a reasonably robust pace. And I think that's a positive for the outlook for the aviation industry in 2019. And indeed, if you look at what's happened to air travel so far this year through to October, there's clearly a lot of momentum in air travel across all sorts of major air travel markets. And if you look at the bottom, the blue bars show the year-on-year growth in the year to October. India has been the strongest growing market. We've seen growth of about 20% in India, followed by China. Their domestic market has been growing very strongly as well. Actually, the contribution to global travel growth has been larger from China because it's a bigger market. The other big contributions to the growth we've seen this year have been in international travel in Europe, European international travel, and also Asia Pacific, which together have contributed around about half of the growth we've seen in travel. So the travel growth we've seen is widespread, and I would say it's got considerable momentum as we go into 2019. So what do we think about next year? There's going to be some slowdown. We are expecting to see global growth slow a little, and we certainly haven't got the impetus that we had in previous years. But we're still expecting to see growth of 6% in passenger kilometres flown by the airline industry. That is pretty good growth. It's slower than this year, slightly, but it's still above the 20-year trend of just over 5%. Cargo is a slightly different story. We had a very good year of growth in 2017 for air cargo as the economic cycle picked up. This year it's slowed down quite sharply, and this is a part of the airline business that we think is being damaged by the protectionism that we're seeing. We have seen this for some time. The tariffs are the latest in an episode of border frictions and borders getting more closed. We're expecting to see 3.7% growth in ton kilometres flown by the cargo industry. But that's still a reasonably positive outlook. I think the second major positive factor for the outlook is that we've got much lower oil prices and much lower jet fuel prices than we had just a month ago. We've seen a big change around, which began, of course, with the reassessment of the Iran sanctions. But I think more fundamentally, it's that we've seen a lot of oil supply, particularly from the US, as you can see. And the US is facing pipeline difficulties, but it doesn't look as if that stopped the rapid increase in production. OPEC are clearly going to be cutting back, but the expectation is that that will be insufficient to stop the build-up of inventories of oil that will continue to cap oil prices. So the expectation, you can see the futures price of fuel, which is in the low 60s at the moment. The expectation is that that's where it will stay in the next 12 months, between $60 and $70 a barrel. Now, our forecasts are based on an average of $65 a barrel for Brent crude oil, which is considerably lower than the $73 that we've seen this year. So a second significant positive, I think, for the outlook for airlines. The full benefit of that actually won't be felt this year because, particularly here in Europe, airlines are hedging their fuel bills, their fuel consumption, so they bought ahead, probably on average about 80% here in Europe. That will delay the benefits of the fall in fuel prices that we're seeing here. And then the second element is that we're actually starting to see some environmental regulations from the shipping industry, where they're being, the shipping industry are switching away from high sulfur fuels, actually increasing the pressure on aviation, because that means they're switching to diesel, which competes for jet kerosene in the barrel and the refineries. That's going to widen the spread. So those two factors will delay the benefits, but clearly a positive. And I think the result that we'll see from that is that the lower fuel prices will ease some of the downward pressure on profitability that we saw in the middle of this year. And the red line here strips out the seasonal ups and downs of airline industry operating margins. And I think it's clear that, particularly in the second quarter, and we've also seen this in the third quarter of this year, we saw quite a steep fall in profitability as the industry got squeezed by higher costs. We think the fourth quarter is going to look quite a lot better because of the fall in fuel prices that we've seen. But actually, just going back to that slide, I mean, one other point to make is that although we've seen a squeeze on airline profits in the middle of this year, the level is still considerably higher than it was just a few years ago. And I guess the key question is why? I think the reason is that we've actually seen some change, some structural change in airlines' financial performance. And we can see that if we look at load factors, and these load factors are a combination of both the passenger business and the cargo business, so they're lower than the ones you see normally with passenger load factors. The key point is that these load factors compared to break-even levels have widened out after the global financial crisis. And it's that gap between these two that measures the scale of profitability, the size of return on capital. And as you can see, that gap's widened out and it's stayed there. This is representative of a change in the way airlines have been doing business. And this has been the thing that has kept profitability above where it would have been in previous years. Now, it's clear that the break-even point has been rising in the last couple of years because of the higher fuel prices that we saw until recently. We were actually expecting that this year to more or less stabilise, partly because fuel prices have fallen, but perhaps more importantly because airlines are introducing ancillaries. They're unbundling their product. You'll hear more later about NDC, which is a key project that enables airlines to sell ancillaries, but the fact they're doing that is helping to keep break-even points lower. And then the second change has been in the way airlines have been managing their assets and utilising their assets. They've managed to keep load factors high, which of course is, I'm sure we'd all prefer to have empty seats next to us, but actually for a capital-intensive business, keeping high utilisation, high load factors is critical for profitability. And so we'd expect to see this gap stabilise this year. And essentially that translates straight through to the bottom line. And it means that what we expect to happen to profitability and return on capital is it will stabilise this year, in 2019. We've seen some downward pressure on return on capital, the blue line, in the last couple of years, but the combination of these structural improvements, the reasonably strong economic growth expected and the lower fuel prices means that we would expect to see profitability and returns stabilise. So we're expecting 8.6% on average for the return on capital. This is the key metric for investors. This is what they're going to be looking at in order to invest in airlines or lend money to airlines. And the key thing is that airlines are able to generate sufficient profits and return on capital to be above that red line. That red line is essentially what investors could earn if they took their money and invested it elsewhere. That's really the minimum that the industry needs to achieve. And what we see here is that airlines, have been able to do this for the last 4 years. And it's something that they haven't been able to do previously. And it's really important to attract capital that they continue to be able to do this. And we think that in 2019, we'll actually see the 5th successive year where airlines are creating value for their investors rather than destroying it as they did before. Now, in terms of what that means for other measures of profitability, EBIT margins or operating margins, they will be similarly stable in 2019. EBIT margins, operating margins at 6.8%. And for net post-tax profits in dollar terms, we would expect to see the 10th successive year of profit. Actually, that's a record. The industry has never actually managed to have that long a period of profitability before. But it's not just investors that the industry is delivering value to, and we expect to deliver value to in 2019. It's also consumers, businesses, and the wider economy. The main way that we do that is connecting cities. And last year, there were over 1,300 new city pair connections established by airlines. So we're now over 21,000 unique city pair connections. The industry is connecting twice as many cities as it did 20 years ago. And it's those bridges, those connections between cities that first of all offer consumers choice, but that's also the path of economic development. That's how businesses reach markets, attract labour, get tourists. This is the key thing that generates economic benefit. So I think it's clear that we're delivering choice to consumers and benefits to business and the wider economy at a lower and lower real cost as well. The red line shows the real cost for users to travel, so adjusting for inflation, so it's comparing travel and transport costs to the costs of other consumer goods, and that's halved in the last 20 years. The combination of the two shows the extent of the benefits. The industry is generating more tax revenues for governments. We estimate that we'll see more than $130 billion of tax revenues of payroll, corporation, ticket taxes paid to governments by the industry this year. That is 44% of the industry's value added, and jobs as well. But that's the good news. The bad news, or the challenges, are that the industry is facing quite severe cost pressures. We've seen oil fall substantially, and that is the industry's second biggest cost. But labour's the biggest cost, and we're seeing significant labour pressures, and we're seeing significant other non-oil cost pressures. The last 12 months, the industry has been battling to deal with that. It's managed, for the most part, to recover those costs, although that faltered, that ability to recover those costs faltered in the second quarter. And we think that's a challenge that will be enduring in 2019. This is the OECD's view of the world. Essentially, the OECD is saying that in those developed economies, the economic expansion has used up all the spare capacity that there is. And so the OECD economies are expected to be operating, look at the red line, above full capacity. And unemployment has fallen to below pre-global financial crisis levels. So we're expecting to see both rising cost pressures and rising wage pressures. And this is a broader challenge across the economies, but this is something that airlines are going to be facing. I think in terms of what IATA is doing, its cost-fighting programs that you'll hear something about are going to be critical for the airline industry over the next year. In this sort of environment, interest rates are going to continue to be under upward pressure, and we've already seen that, particularly in the US. And the fact here, you can see that US interest rates have already risen faster than elsewhere. That's created a strong dollar environment. And I think there are two issues here. One is that this means the cost of servicing debt rises, but secondly, there are issues with the rise in the dollar. And if you look at what's happened to a number of key exchange rates against the dollar, it's clear that there have been some major challenges for airlines in particular countries, particular parts of the world, because major cost items like fuel and aircraft are priced in US dollars. So if you're an airline in Argentina, Turkey, Brazil, India, Indonesia, you've seen those costs in local currency terms rise tremendously. That's been a tremendous challenge for airlines in those regions. And I guess the key question is, is the environment going to lead to more dollar strength and more pressure on those airlines? I think debt is also a challenge still for the industry. The industry is really transformed into two groups by regions. This shows a very common metric that the credit rating agencies used. It's essentially the ratio of debt to earnings, with some adjustments. What we've seen in Europe and North America is a real transformation. They've managed to have substantial free cash flow and they've been able to pay down debt. They've been able to reduce their debt and their debt ratios to what is considered by the credit rating agencies more or less investment grade credits. That's a remarkable transformation from the industry we saw just 5 or 6 years ago. But in other parts of the world, we haven't really seen that improvement. There's more to do. We've got debt of 5 to 7 times earnings. There's still vulnerability to a faster rise in interest rates. And finally, our conclusion is that the outlook for 2019 is that we should see some stability in profitability for the industry. We expect to see the industry generate its 10th successive year of post-tax profits and its 5th year where its return on capital is creating value for its investors. But I think the other feature that we're expecting to see in 2019 is a still wide divergence of performance. The North American airlines are in a good situation, both in terms of their business environment and also the restructuring of the industry, and they're expected to continue to produce more or less half of the profits of the industry, but less so elsewhere. There is more that the industry, with the help of IATA, needs to do to ensure that the industry has a financially healthy future in all regions. Thank you very much.
Thank you, Brian. So, as you see, we are cautiously optimistic on 2019. With a 4% net margin, the first point to emphasize is that it is basically a similar performance to 2018. That could be a surprise to some of you, given the gloom in the market. But demand is strong, and we have seen a major drop in oil prices. So it has the main explanation for this forecast. The second point is that the buffer between profit and loss is thin. $1 for a new tax, an increase in charges, or shift in the oil price can eat away at the $7.75 US per passenger profit very quickly. We are in a different league from Apple, for example, which makes $400 US for every iPhone XS sold. Not exactly the same number that we have. Governments should not view this industry's better financial footing as a blanket bill of health, nor a blank check. The aviation industry is on a more solid financial footing than at any time in its history. But to keep delivering the economic and social benefits that only aviation can, it needs a business-friendly policy framework that supports competitiveness. And you will be hearing us speak a lot about that in the coming year. So you have a very stimulating day ahead of you. Interesting topics such as digital transformation, unruly passengers, new forms of payment, and much more. you will see that IATA touches pretty much every aspect of the air transport sector. And we hope that the topics discussed today will help you with your reporting throughout the year. I will close with a reminder of just how special aviation is. Economically, it's a critical enabler of the global economy. We support nearly 66 million jobs, and we underpin 3.6% of global GDP with an economic impact of $2.7 trillion annually. Our recent polling revealed that nearly half of travelers consider air travel to be exciting, with more than a third even saying that it's glamorous. Yeah? I don't know why you are laughing. It's glamorous. As I said at the beginning, for me aviation is the business of freedom, which becomes even more meaningful as we enter this busy holiday travel period to reunite with family and friends. As you will see today, IATA is working hard to support the success of this business of freedom with a focus on safety, efficiency, sustainability, both financial and environmental. And now, I would like to open the floor for your questions. We'll try to answer your questions from everyone on this table.
Hey, great. Thank you very much, Alexander, Michael, and Brian. We're now ready for questions. We're still 25 minutes away from the embargo. I'll just remind you that. So another 25 minutes before the embargo is lifted. In the meantime, if you have questions, if you could raise your hand. And when you ask your question, if you could identify yourself as well as your publication, that would be much appreciated. Maybe we'll start with one in the center here. Yeah.
So I'm Theodor Kurtner from Hungary News Agency. So with these markers in 2019 and with the oil prices leveling up, what do you think will in the European market continue the falling of airlines and the consolidation in this market? Thank you.
I'll take that. Yeah, Europe is not in as good a situation as the US, partly because it's not going to see the full benefit of the lower fuel prices. Hedging ratios for many European airlines are up to 80%, so it really won't be until 2020 when they see those benefits. And the European economies have certainly been softer than we've seen on the other side of the Atlantic or in Asia. And there are a lot of aircraft to absorb in Europe as well. I guess the combination of those factors is likely to mean it will continue to be quite a competitive environment in 2019.
The other point we could add is that compared to the US, the consolidation in Europe has been less active. There are more players, either in the low-cost area and in the traditional full-service legacy carriers. So, could happen.
We'll take a question maybe from Marissa.
Yes, Brian, this is, hold on, I'm trying to figure it. Brian, this is in reference also, I cannot do this. Okay, I feel
And just if you could start with your name and your publication, that would be great.
Okay. Is it working? Okay. Sorry about that. Marissa Garcia, FC Media. Can't operate a microphone. Brian, in terms of the overall dip in return, and one of the things that I see on the I don't know if they're quarterly or monthly passenger reports that keep coming out, is that the push on yields in terms of revenue from premium versus economy passengers. Do you see any risks at all of dilution of yield in terms of the fare base I'm referring to? Just in having too many fares competitions going on that are starting to eat away at this, or can you correlate this dip exclusively to costs?
obviously it's lower costs that have been driving the fall in the cost of air transport. The reason that passengers and businesses have benefited from that is because it's a highly competitive industry. Those have been passed on. I guess what we've seen in the recent past is that airlines have been mainly recovering the cost of the rising fuel prices that we had until the last couple of months through the front cabin. So we've actually seen business fares showing much more stability. Economy fares have been continuing to decline, which is obviously great news for leisure travellers. And that's a typical pattern. I guess the worry might be if the trade wars cause international trade to weaken significantly. That's a large chunk of those business passengers. So that's something that we'll worry about and keep an eye on. We're hoping that actually we won't see the escalation of the tariff wars, and certainly our forecast is based on some stability there.
Maybe a question